Imagine for a second you run a major European company. For years, you've been cautious, delaying big projects. But right now, in early 2026, the floodgates have burst open. Lenders are practically throwing cash at you. This isn't safe, government-backed money. It's the riskiest corporate IOU junk debt, and sales have soared by a staggering 30% in just the last quarter. The mainstream headlines are cheering. They call it a return of market confidence, a sign that the ghost of trade war threats has been banished. But this debt-fueled boom isn't just happening in distant boardrooms. It's quietly seeping into your pension plan. It's underwriting the stability of your bank. What if this isn't a recovery? What if it's just the final, frantic hour of a party right before the lights come on? To understand how we got here, you have to rewind the clock. Back to the 1980s. This wasn't just about big hair and synth pop. It was the dawn of a new financial age. In America, and soon after in Europe, regulators loosened their grip. Wall Street unleashed a powerful new weapon, the high-yield bond. They gave it a nickname, the junk bond. Before this, borrowing money was for the safe bets, the blue-chip giants. But now, risk itself was a product. A company on the edge, a corporate raider planning a hostile takeover, suddenly they could get funding. The promise of huge returns convinced lenders to ignore the flashing red lights. This was the original sin of the modern debt market, the decision that massive risk was a price worth paying for explosive growth. The idea was intoxicating. For decades, this market simmered. It had booms, it had busts. But then came 2008. The great financial crisis changed everything. To save the global economy, central banks turned on the money taps. They slashed interest rates to near zero and began a policy of quantitative easing, flooding the system with trillions in cheap cash. This created a decade-long paradox I call the Great Yield Famine. If you were an investor, a pension fund, an insurance company, you couldn't make money from safe government bonds anymore. They paid almost nothing. So where did you put your cash? You were forced to hunt for returns in riskier territory. You had to buy junk. European companies, in turn, got hooked on this cheap credit. It was a lifeline. It let them expand, hire, and survive. It became the background radiation of the entire economy, a system addicted to easy money, with investors starved for any kind of decent return. The stage was set. All the components for an explosion were in place, just waiting for a spark. And then, the political winds shifted, the biggest fears began to fade, and someone lit the match. But this isn't some abstract story for corporate boardrooms. This is a story about your money, your pension fund, the mortgage on your home, the very stability of the job you go to every day. It's all connected to this invisible ocean of debt. Consider this. Right now, the average European pension fund, the pot of money meant to secure your retirement for decades, holds less than 5% of its assets in these high-yield, high-risk bonds. For years, that 5% was a guardrail, a safety measure. But that guardrail is buckling under the pressure of what we can call the zero-yield trap. When safe government bonds pay almost nothing, the people managing your future are forced to hunt for returns in the darkest corners of the market. It's a brutal choice. They can either fail to meet the promises made to you, or they can roll the dice on riskier debt. Suddenly, that 5% doesn't look like a limit, it looks like an untapped resource. A gamble they are now incentivized to take with your future. So why is this happening now? What flipped the switch that turned caution into a casino? The idea, born in American finance, was simple and seductive. Why should only the safest, biggest companies get to borrow money? What if you could lend to riskier businesses, but charge them a much higher interest rate to compensate for that risk? This was the birth of the high-yield, or junk, bond market, a financial tool that promised to unlock growth for underdog companies and deliver massive returns for daring investors. The original sin was right there in the code. Profit was a powerful anesthetic for the fear of default. Then came the great financial meltdown. In its aftermath, central banks in Europe and across the globe deployed their ultimate weapon. They pushed interest rates to the floor. And then through the floor. The goal was to make borrowing so cheap that companies would have no choice but to invest and expand. It was sold as a temporary fix, a shot of adrenaline for a dying patient. But the emergency lasted for more than a decade. It became the new normal, a system I call the whatever-it-takes backstop. This permanently changed the rules of the game. If you managed a pension fund, you couldn't survive on the near-zero returns of safe government bonds. You were forced out onto the ice, hunting for yield in riskier territory. This created a bottomless hunger for junk debt. For companies, it was a dream come true. Even with a shaky business plan, you could find a lender. Debt became a cheap, endless resource, like water from a tap. This system didn't just fuel a boom. It fundamentally rewired the DNA of European business. It created a deep, structural dependency on cheap credit. But this dependency masks a dangerous, hidden mechanism, one that operates just beneath the surface of the market. So how does this all actually work? How does a risky company in Germany or Italy suddenly get a fire hose of cash from investors who should know better? It's not magic. It's a machine, a mechanism I call the yield-hungry pipeline, and it works in 3 distinct stages. First, the source, your pension fund, the insurance company that holds your policy. These are giant pools of money, legally required to grow, but with safe government bonds paying almost nothing, they're starving. They need yield, and they need it now. This creates a colossal, desperate demand for anything that pays more than zero. Second, the processor. This is where the investment banks step in. They see this hunger and build a pipeline to feed it. Think of it like a food processing plant. The banks go out and find the raw ingredients, risky loans to struggling European companies, the corporate equivalent of scrap meat. They know holding this junk is dangerous, so they don't. Instead, they chop it up, mix it with hundreds of other risky loans, and press it all into a new shiny package, a high-yield bond. The risk hasn't vanished, it's just been processed, obscured. Finally, the sale. This newly packaged bond, promising a juicy 5 or 6% return, is fed back into the pipeline. It lands right in the portfolio of that starving pension fund. The bank collects a fat fee for arranging the deal. The struggling company gets the cash to survive another year. The pension fund gets the yield it desperately needs. Everyone walks away happy. On paper, it's a perfect, self-sustaining system, a miracle of modern finance that connects hungry capital with needy businesses. This entire pipeline is built on one critical, unspoken assumption. An assumption that, when you actually run the numbers, is terrifyingly fragile. To see how this story ends, you have to leave the trading floor and go to a factory. A real place, with real people. Let's call it Viridian Automotive, a mid-sized parts manufacturer in Germany. For generations, they built a reputation for quality. But by 2025, the machines were old and the order books were thin. The company's CEO, Klaus Richter, was watching his family's legacy crumble. He needed 250 million euros to retool the factory. To survive, traditional banks said no. Too risky. Then the floodgates opened. A consortium of investors, flush with cash and desperate for returns, offered him the entire amount. The price was an interest rate of 8.5%. It was steep, but the terms were seductively easy. For the 200 workers at Viridian, it felt like a miracle. The deal saved their jobs. New, state-of-the-art equipment began arriving on the factory floor. For the first time in years, there was a sense of optimism. A future. But that future was built on a knife's edge. A mechanism we can call the Repayment Razor. Every year, Viridian had to send over 21 million euros to its lenders. Not to pay down the loan, but just to cover the interest. This wasn't profit. This was a tax on survival. Every spare cent was vacuumed out of the company to feed the debt. There was no money for R&D. No cash reserves for a rainy day. The company was alive, but it couldn't breathe. Then the stumble came. It wasn't a crisis. It was a minor supply chain delay. An important customer paid their bill 60 days late. Normally, this would be a manageable problem. But for a company stretched this thin, it was a catastrophe. Viridian missed an interest payment. The reaction was brutal and swift. The company's credit was downgraded overnight. The investors, who had seemed like saviors, were now circling like vultures. The new machinery sat gleaming on the factory floor, a monument to a future that would never arrive. 200 layoff notices went out the next week. The hope that had filled the town just months earlier had curdled into fear. Viridian was the first domino to fall. But this was just the beginning. It's a process I call debt alchemy, and it works in 4 distinct stages. First, you have the architect. This is a major investment bank in London or Frankfurt. They approach a company that's desperate for cash, a business with a shaky balance sheet, a company that traditional banks would turn away. The architect doesn't see a risk. They see raw material. They agree to arrange a massive loan, but they have no intention of holding onto it themselves. That would be far too dangerous. Second comes the blend. The bank takes this risky loan and doesn't sell it alone. Instead, they bundle it. They chop it up and mix it with dozens, sometimes hundreds of other loans from other similarly stressed companies across the continent. Think of it like making a sausage. You don't know exactly what cuts a meter going in, you just see the final neatly packaged product. A piece of a struggling Spanish retailer gets mixed with a slice of an over-leveraged Italian construction firm. The individual risk of any single company gets lost in the crowd. This is the step most people never see. The complexity isn't a bug, it's a feature, it's financial camouflage. Third, the stamp of approval. This packaged sausage of debt is taken to a credit rating agency. The agency's job is to taste the sausage and give it a grade. And because the package is so diversified, they often give it a surprisingly respectable rating. A collection of single B-rated companies, when bundled together, can suddenly get a portfolio rating of double B or even higher. It looks safer than it actually is. This single letter grade is the key that unlocks the final stage. Which brings us to stage 4, the dispersal. With that official rating, the bank can now sell slices of this debt package to the wider market. And who buys it? Your pension fund, your insurance company, the conservative investment fund managing your retirement savings. They aren't buying a loan to a failing factory. They're buying a, quote, diversified rated European high-yield bond product. The original risk, born in that one struggling company, has been alchemized, repackaged, and quietly placed into your portfolio. You never saw it happen, but the fuse has been lit. The only question is how much leverage was used to make the numbers look so good? And what happens when a few of those hidden loans start to fail? The answer isn't a matter of opinion, it's a matter of math. If Viridian Automotive was a tremor, then Ethelred Luxuries was the earthquake. This wasn't some mid-sized supplier in a single country. This was a titan of European retail. Based in Milan, Ethelred's iconic blue bags were a fixture on the continent's high streets for generations. But behind the polished marble floors, the company was bleeding cash. It was chained to hundreds of expensive physical stores, while nimble online rivals ate its lunch. The architects of dead Alchemy saw an opportunity, not for a rescue, but for a feast. They approached Ethelred with the same seductive promise they made to Viridian, but this time, the numbers had more zeros. We're not talking about a few hundred million, we're talking billions. The playbook was identical. The only difference was the scale. And here's the truly chilling part. The lessons from the first wave of failures were completely ignored. Investors, desperate for any return in a barren market, lined up. They saw the flashing red lights. They knew this new debt wasn't for innovation or growth, it was just to pay the bills, to keep the lights on in empty stores. They bought the bonds anyway. This is a pattern I call the anchor fall. A company becomes so large, so intertwined with suppliers, landlords, and regional economies that its failure doesn't just create a splash. It creates a whirlpool, dragging hundreds of smaller, healthier businesses down with it. The bankers had just tied a mountain of new debt to the biggest anchor in the European retail sea. The markets cheered. A successful recapitalization, the headlines read, a vote of confidence. But it was a mirage. The debt didn't fix the underlying business. It just postponed the funeral and made the inevitable collapse that much bigger. The very same pension funds that held Viridian's worthless paper were now proudly adding Ethelred's to their portfolios. The lesson hadn't been learned. The stakes had just been raised. And here's where it gets personal. The numbers tell a story the headlines miss. Let's do the math. Not the complex algebra of derivatives, but the brutal arithmetic of leverage. Imagine a healthy French tech firm, valued at a solid 1 billion euros. It's all equity, owned outright by its founders and early investors. A picture of stability. But they want to grow fast, so they issue 2 billion euros in these new, easy-access corporate notes. Overnight, they are a 3 billion euro company. On paper, a titan. But look closer. That original 1 billion in equity is now just a 1/3 cushion against 3 billion in assets. The other 2/3? Pure debt. This creates a terrifying vulnerability I call the amplification trigger. Here's how it works. Let's say a minor recession hits. The company's total value falls by just 20%. Not a catastrophe, right? A 20% drop on 3 billion is 600 million euros. But that loss doesn't come from the lenders. It comes directly out of the owners' pockets. Their 1 billion euro cushion is now slashed by 600 million. In a single quarter, over half their wealth has simply vanished. A 20% downturn has triggered a 60% personal loss. That is the brutal power of the trigger. Now multiply that effect across hundreds of companies. A small economic dip no longer causes a small dip in the market. It becomes a catastrophic wealth erasing event for the owners, forcing them to sell assets, fire workers, and slash costs just to stay solvent. This isn't a bug in the system. It's the feature, a machine designed to magnify gains that will inevitably magnify the losses. So what happens when this trigger is pulled, not just on one company, but on the entire economy? What are the real-world scenarios? Now, a skeptic watching this might say you're being an alarmist. And they have a point. They'll show you charts where corporate default rates in Europe are hovering near historic lows. They'll argue that this surge in borrowing is a sign of health, of ambition. It's capital flowing to where it's needed most, fueling innovation and creating jobs. They'll tell you that modern financial instruments have spread the risk so wide that no single failure could ever bring down the system. That this time, it's different. This argument is seductive because, on the surface, it's true. But it relies on a dangerous sleight of hand I call the duration fallacy. It mistakes a calm sea for a tide that will never turn. The low default rate isn't a sign of permanent safety. It's a symptom of the cheap money itself. When credit is easy, even the weakest swimmers can stay afloat. The real test comes when the tide goes out. And when it does, the second illusion is shattered, the myth of recovery. The data is unforgiving. Historically, when a high-risk company defaults, investors get back, on average, just 40 cents on the dollar. During a market panic, that can drop to less than 20. The other 80% of your investment doesn't just get delayed, it evaporates. To be clear, the optimists aren't entirely wrong. In a perfect world of steady growth, many of these bets would pay off. The risk is calculated, and for a time, manageable. It creates a powerful sense of security, a belief that the machine is too robust to fail. But even if they were right, so what happens next? The future isn't a single road. It's a fork. Two distinct paths lie ahead for Europe's mountain of corporate debt. Scenario A is the one most economists are betting on. I call it the long sickness. In this future, there is no sudden crash. Instead, corporate defaults tick up, slowly, painfully. 1% this quarter, 2% the next. It's a low-grade fever for the entire economy. Growth stagnates. Your mortgage costs creep higher. Getting a car loan gets just a little bit harder. The system bends, but it doesn't break. Central banks intervene, propping up the weakest links just enough to prevent a total collapse. This isn't a heart attack. It's a chronic illness, draining the continent's vitality for a decade. But then there is scenario B, the tail risk. The low-probability, high-impact event that keeps central bankers awake at night. This is the glass floor scenario. Here, a single, unexpected default by a major company isn't contained. It shatters confidence overnight. Credit markets freeze solid. The machine that funnels cash to businesses simply stops. It's not a slow bleed, it's a sudden hemorrhage. The probability may be low, maybe 1 in 20, but the consequences are total. It's a cascade where your pension fund is linked to a Spanish retailer you've never heard of, and its failure brings the whole structure down. Of course, there are very smart people who will tell you both of these scenarios are pure fantasy. They argue the financial system has built-in circuit breakers, that regulators are far more vigilant now than they were before the last great crisis. They believe the safeguards will hold, and that this boom is simply a sign of a healthy economy finally getting back on its feet. I know what the smartest people in the room are thinking. They're looking at their terminals and saying, this is just alarmism. The market is rational. Look at the numbers. Corporate default rates in Europe are scraping the floor. They're near historic lows, and they are not wrong. That data point is true. If you only look at defaults, the European market looks as safe as a Swiss vault. It's the single most powerful argument for for why this debt-fueled party can continue indefinitely. It's the lullaby the entire system sings to itself, but it's also a masterclass in misdirection, because it ignores a hidden metric, a number I call the covenant score. This measures the strength of the legal protections baked into a loan. The rules that stop a company from, say, paying out a massive dividend to shareholders instead of servicing its debt. According to data from Moody's, the average covenant score for newly issued European junk debt has fallen by more than a fifth in just the last year. Let's be clear about what that means. Investors are so hungry for returns, they are willingly stripping out the safety features. They're removing the legal airbags and seatbelts from these deals. The default rate looks stable now because the economic road is straight and the weather is clear. But the moment we hit a curve, or a patch of ice, there is nothing to prevent a catastrophic pileup. This isn't the sign of a confident market, it's the mark of a complacent one. And this reveals a fracture in how we see the world. It's not just about a chart. It's a fundamental disagreement on the nature of risk itself. And that's where my analysis truly begins. So, the inevitable question, what am I doing with my own money? Before I answer the mandatory part. I am not a financial advisor, and this is purely for educational purposes. You should always do your own research. Now, my strategy. I call it holding dry powder. The vast majority of my risk capital is currently allocated to short-term, highly liquid government instruments. It's boring. It barely beats inflation. But it's not meant to make me rich. It's meant to keep me ready. My actual exposure to the assets we've discussed is surgically small, less than 5% of my portfolio. My position sizing here is based on a simple principle: survive first, profit later. My trigger to deploy the rest isn't a market dip or a positive headline. It's a specific signal in the credit markets. I'm watching for a sustained compression in credit spreads for 2 consecutive months. That's my tell. That's the signal that the real fear is subsiding, not just the perceived fear. But this defensive posture creates a paradox. While I'm waiting for the storm, all this cheap money and desperate chasing for returns is creating immense pressure. It's building the perfect fuel for a fire that could ignite a shocking, face-ripping rally that punishes anyone sitting on the sidelines. So this is the machine, an engine humming on cheap debt, powering an economy of corporate zombies, while the architects insist the foundation is solid. But you've seen the brutal arithmetic. You understand the leverage hiding in plain sight. This isn't some distant financial storm. It's a pressure system building directly overhead. The question is no longer if the dam breaks, but how you prepare for the flood. Understanding the danger is the first step. Our next investigation focuses on the second, spotting the shelters. We're mapping the early warning signs that precede a market shock, the tremors before the quake. Follow our work to get that intelligence. Because in a system built this fragile, the music is about to stop. And you don't want to be left without a chair